If I had to start investing completely from scratch in 2026, I would build a simple financial system before chasing complicated investment opportunities.
I wouldn't begin by searching for the hottest stock, because my first priority would be creating financial stability that can survive uncertainty.
The biggest beginner mistake isn't necessarily choosing one bad investment, it's creating a strategy that encourages emotional decisions later.
Before investing anything, I would first understand exactly where my income goes, how much I spend, and what financial obligations already exist. I would give every dollar a specific job, separating money needed soon from money designed to remain invested for many years. I wouldn't invest money that I might need soon, because a market decline could force me to sell investments at exactly the wrong moment.
My investment decisions would depend heavily on time horizon, because money needed soon requires a completely different approach from long-term wealth. Next, I would clearly define what I'm investing for, because knowing the destination makes it much easier to choose an appropriate strategy.
I would write down one clear financial objective, instead of investing randomly and hoping the portfolio eventually becomes valuable enough.
Money for a near-term purchase shouldn't be treated like retirement money, because each financial goal has different risks and timelines.
For long-term investing, I would become comfortable with temporary market declines instead of expecting prices to move upward every single year.
I would keep my portfolio diversified so that one company's problems wouldn't have the power to completely destroy my financial progress. Rather than depending on one company, I would consider broad market investments that spread exposure across many businesses and industries.
I would pay attention to investment costs. Small recurring fees can quietly reduce the amount of wealth that compounds over many years.
After creating the strategy, I would automate regular contributions so investing doesn't depend on whether I feel motivated or confident each month.
Automation matters because emotions often become dangerous during market extremes, encouraging investors to buy from excitement and sell from fear. I wouldn't try to predict every market move, because building a reliable long-term system is more realistic than forecasting tomorrow's headlines.
I would accept that nobody knows exactly where markets will move next, and I wouldn't build my financial future around uncertain predictions.
There will always be someone predicting a crash and someone predicting a rally. But neither prediction should control my long-term investment decisions.
Instead of reacting to every headline, I would focus on diversification, consistency, reasonable expectations, and giving my investments enough time to grow.
I would also learn how major retirement accounts work before putting significant money into them, especially their different tax rules and limitations. If my employer offered matching contributions, I would understand the rules carefully, because that benefit could significantly increase the money being saved for retirement. I would remember that an investment account is simply the container. The investments inside that account still determine what I actually own.
A tax-advantaged account doesn't automatically make every investment inside it smart, so I would still understand what I'm purchasing.
I would stay extremely cautious around social media investment hype, especially when someone makes extraordinary returns look effortless and guaranteed. Online success stories can hide enormous survivorship bias, because people usually showcase spectacular wins while quietly ignoring failed strategies.
I would never buy something simply because another person appears wealthy from owning it, because their situation may be completely different.
Instead, I would develop a simple learning routine focused on understanding how investments work before attempting advanced strategies.
I would first learn the fundamentals, including compound growth, diversification, inflation, risk, exchange-traded funds, stocks, bonds, and long-term investing. I'd understand compound growth, because earning returns on previous returns can become increasingly powerful when money remains invested for long periods.
I would understand that diversification doesn't remove every risk, but it can prevent one investment mistake from becoming a catastrophic financial setback.
I would learn that higher potential returns usually come with greater uncertainty, so my portfolio should match the amount of risk I can actually tolerate.
If I eventually became interested in individual companies, I would research the underlying businesses rather than treating stock prices as the entire story.
I would ask how the company makes money, what could damage the business, whether the valuation seems reasonable, and what would prove my original idea wrong. I might keep a small portion of my portfolio for individual ideas, but I wouldn't allow curiosity to control my entire financial future. Keeping speculative ideas limited would let me learn about companies without putting the majority of my long-term wealth at unnecessary risk. Before buying an individual stock, I would understand what the business actually does, how customers create revenue, and where its competitive advantages come from. I would identify the biggest threats facing the company instead of focusing only on the reasons I might want to own it. I would also consider valuation, because an excellent company can still become a poor investment when the price already assumes unrealistic expectations. Most importantly, I would decide beforehand what evidence could prove my investment thesis wrong, rather than constantly defending my original decision.
Then I would prepare emotionally for market crashes before experiencing one, because fear feels completely different when real money is disappearing.
Before a major decline happened, I would already decide what my response should be, instead of inventing a new strategy during panic.
When markets fall, I would review my original plan first, rather than allowing frightening headlines to make important financial decisions for me.
A temporary market decline wouldn't automatically mean my strategy failed, especially if I was investing for decades rather than months. Long-term investing requires accepting that markets can experience difficult periods, sometimes lasting much longer than impatient investors expect.
As my income increased, I would try to increase my investments too, instead of allowing every raise to disappear into higher lifestyle expenses. Growing the amount of money I contribute can be just as important early on as obsessing over small differences in investment performance.
In the beginning, consistent contributions can make a huge difference because you're repeatedly adding fresh capital to the compounding process.
I wouldn't obsess over whether my portfolio beat the market every single month, because short-term performance tells me very little about long-term success.
I would track a few meaningful numbers, including how much I invest, how much I save, what I pay in costs, and whether my allocation remains appropriate. I wouldn't check my portfolio constantly, because frequent monitoring can create unnecessary emotions without improving the underlying investment strategy.
I would review my portfolio periodically, but the purpose would be checking whether my strategy still fits my life, not finding reasons to trade.
Every portfolio decision should connect back to my financial goals. Because investments are tools for building a future rather than entertainment.
If my circumstances changed significantly, I would reconsider the plan, instead of blindly following an old strategy that no longer matches my situation. A good financial plan should be flexible enough to adapt. When income, expenses, responsibilities, or long-term goals change unexpectedly, I would stop waiting for the perfect moment, because markets rarely provide perfect certainty, and waiting indefinitely can become its own financial decision. Spending years waiting for a perfect entry point can mean missing valuable time that could have been spent building disciplined investing habits. I wouldn't believe I needed a huge amount of money before beginning, because responsible investing can start with an amount that fits the budget.
I would focus on taking one sensible step at a time, rather than overwhelming myself with every advanced investing concept immediately.
My knowledge would grow alongside my portfolio,
allowing me to become more confident without pretending that I already knew everything.
I would choose a strategy I could explain clearly, because complexity doesn't automatically create better results and can make mistakes harder to recognize.
If I couldn't explain why an investment belonged in my portfolio, I would pause before putting real money into it.
I would learn from different sources, but make decisions according to a personal framework, rather than constantly switching strategies whenever someone offers new advice.
My rules would be simple enough to remember during stressful markets, because complicated plans often become difficult to follow when emotions become intense.
The strongest investing system isn't the one that looks impressive during good times. It's the one you can continue following when conditions become uncomfortable.
I would expect different market environments and build habits that don't depend on every year producing positive returns or exciting opportunities.
My biggest advantage would be time, because consistent investing can allow many small decisions to accumulate into something much larger.
I wouldn't measure progress only by today's account balance. I would also measure whether my decisions are moving me closer to financial independence.
The real power of investing doesn't come from one brilliant decision. It comes from repeatedly making reasonable decisions while allowing enough time for them to compound.
I would accept that some years could feel disappointing, because long-term wealth doesn't require every period to look impressive.
I wouldn't judge my entire strategy based on one difficult year, because short-term market performance can be extremely unpredictable.
My attention would stay on long-term progress, rather than daily price movements that can create unnecessary excitement, fear, or impatience.
Every regular contribution would represent another brick in the financial foundation I was building for my future.
I would prioritize financial habits that strengthen the foundation before worrying about advanced strategies designed to produce marginal improvements.
If an investment sounded incredibly complicated or promised unusually easy returns, I would slow down and investigate before committing any money. I would look beyond marketing language and ask what risks, costs, assumptions, and limitations were hidden behind the attractive presentation.
Before buying anything, I would make sure I understood why I wanted it, how risky it was, what it cost, and how long I expected to hold it.
I would evaluate investments as parts of a complete financial plan instead of judging each purchase separately.
Sometimes the smartest investing decision isn't choosing another asset, it's improving the financial situation surrounding the portfolio.
I would keep improving the parts of my finances that increase my ability to invest consistently, especially savings habits and spending discipline.
Building wealth isn't only about investment returns. Increasing the amount of money available to invest can dramatically improve the overall outcome.
When my income increased, I would avoid automatically increasing every expense and instead consider sending part of that additional income toward future wealth.
I'd still enjoy my money, but I would make sure lifestyle improvements didn't consume every opportunity to strengthen my financial future.
The goal wouldn't be constantly thinking about money. The goal would be creating a system that works quietly while I focus on living my life.
If I started today, I would want my investing system to become boring enough that staying consistent felt easier than constantly changing direction.
I would rather understand a simple strategy completely than own complicated investments that I cannot explain or confidently evaluate.
Successful investing doesn't require making every decision complicated. Often, consistency and discipline matter more than adding unnecessary complexity.
I would deliberately ignore distractions that encourage constant trading, because every unnecessary decision creates another opportunity to make an emotional mistake.
Market news can be useful for awareness, but I wouldn't allow every dramatic headline to rewrite a financial plan designed for decades.
Every so often, I would step back and ask whether my strategy still makes sense, based on my goals, circumstances, and ability to handle risk.
As life changed, I would allow my financial strategy to evolve while keeping the fundamental principles of discipline, diversification, and patience intact. Building meaningful wealth can feel slow at first, but repeated contributions can gradually transform a small beginning into something surprisingly substantial. Every contribution might seem insignificant by itself, but thousands of consistent financial decisions can create a completely different future.
I would focus less on finding the perfect investment and more on becoming the kind of investor capable of staying disciplined through difficult periods.
Emotional discipline could become one of my greatest advantages because markets can challenge even the strongest strategy when fear takes control.
I wouldn't want investing to consume my entire life. I would build systems that allow progress without constantly watching prices.
The ultimate purpose of investing isn't simply seeing a larger number on a screen. It's creating more financial choices for your future.
Over time, a disciplined portfolio can potentially give you greater flexibility, more security, and more freedom to make decisions based on your priorities. If I were starting in 2026, I wouldn't chase overnight wealth. I would build a repeatable system designed to become stronger through years of disciplined action.
The goal wouldn't be winning every week. It would be staying invested intelligently for many years, continuously learning, and giving compounding enough time to work.